All right, peer-to-peer private capital markets using Monero and Zano. Before we get into this, I want to have a disclaimer. Of course, this is not legal, tax, financial, or any kind of advice. Check the laws of your local jurisdiction before you start doing this kind of thing. If you start doing this kind of thing, uh, for this presentation, we're just kind of exploring what's possible with the technologies we have. So it's not an advocacy type thing, but this is something that we're just kind of playing around with. And given we're playing around with it, this could be totally retarded. There could be massive holes in this idea, and there probably are. So I'm not responsible if something goes totally wayside. Uh, so in regards to some of the terms that we're going to be using, you can go ahead and read all this. I assume if you're a listener of the channel or if you've looked into Zano or Monero before, you're kind of familiar with these kinds of things. Feel free to pause the video, take a look at the definitions of some of these terms. Um, I'm not going to go through all of it right now, but yeah. So for our test case, let's say that we have our friend Mike here, and Mike lives somewhere in the jungle, and he doesn't have access to traditional financing. He can't go open a bank account, and he doesn't want to go get money from some loan sharks. So he's trying to anonymously raise some funds peer to peer through the private capital marketplace. And he wants to start the first Amazonian lemonade stand. So he goes to raise $20,000 in Zano or Freedom Dollar in order to fund the setup and begin his operations. And so, how does he do this? First, he goes to create an auditable wallet. And what he does is he then mints as a confidential asset Mike's Hard Lemonade Stand confidential tokens. He's going to mint 100,000 of them, and he's going to assign them to his wallet, his auditable wallet. He'll create them within that wallet, and he'll create an alias for that wallet so it's easily recognized by the marketplace, MHLS, which will be the ticker, and he can also make his alias that as well. Now, aliases, I think, typically have to be at least 5 characters. I know there are some premium aliases that you can get, or maybe that you could buy. For instance, I have one. It's at Matt, but typically 4 character aliases are not, uh, accessible. So it may be that he's got to come up with something else. So maybe he'll make it, lemonade or something. I don't know, but he'll come up with an alias just so that he doesn't have to share his long string of letters and numbers with everybody to share, you know, the issuing address. Mike will then go to create a social media account for his business to establish an online presence in the market to investors. Now, one thing that you'll kind of see in regards to this is okay, so we want to have a private capital marketplace, but there's got to be some level of assurance that can be provided for the investors because they've got to know that a business exists, B, the business intends on being profitable, and C, there's some evidence of that happening. And or the business intends to pay out dividends and the business intends to have a sustainable existence. So there are different ways that somebody can do this, and the free market will kind of parse this out. And investors will obviously be more comfortable investing in companies for which there's more information that is available. And typically, that will warrant a lower yield or a lower discount rate or whatever it is you want to call it that they're going to demand from the company. The more information you have, the more investment that you can get for cheaper. Presumably, that's how this is going to work. But you also want to protect your anonymity and your identity. And so, you're going to be using Zano and you're going to be doing this peer to peer and you're going to be trying the best you can to balance transparency and privacy. So you're going to establish your social media and you'll be, you know, putting videos out as to, your operations, and you'll be putting stuff out that kind of verifies that you do have a business and you have a profit motive. So Mike, he goes to establish his business plan or prospectus, and this will detail his need for the capital and his strategy to build the profitable business. And in that prospectus, he has, you know, listed out what he needs the money for, and how he intends to make money, information about his local market, and how profitable he thinks his business can be based on how he does things. And so Mike, after releasing this, goes to publish a tracking seed to his auditable wallet so the public can in real time view his Mike's Hard Lemonade Stand token balance, and B, the balances for his Zano, Freedom Dollar, other coins that he's got in there. And for his Zano wallet, it's kind of interesting because you can have one address for not only your Zano, but for all of your confidential assets that you have in that wallet. And so if this person, let's say, is using, uh, you know, private Bitcoin, private DAI, Freedom Dollar, or Zano, and he's using all these different coins because they have maybe different customers that use these different coins, then the public is going to be able to see the cash flows in that wallet for all those different coins at the same time, which is actually pretty convenient and makes the real-time tracking of the business operations pretty straightforward and easy in regards to that. So in his prospectus or in his business plan, he's going to basically offer the dividend payment denomination. And the investors can actually, and I'll get to this a little bit later, but they can actually request when they open up the escrow contract with the issuing wallet to receive their dividend, they can request the cryptocurrency they want to receive in regards to their dividend payment. But Mike can say in the business plan, hey, you're going to be receiving this coin, and that's all you're going to be getting. Or he can say you're going to get Zano, Freedom Dollar, Monero. He can offer Bitcoin and other cryptocurrencies like that, but the risk with that is, they're transparent blockchains, and so somebody can do cluster analysis, or they can, look at metadata that relates to that cryptocurrency activity, and then maybe they can find out who that is, and then that kind of defeats the whole purpose of all this. So he's probably going to focus more on Zano, Freedom Dollar, and Monero, and the investors are probably going to want for that to be the case because the investors, their interest is twofold, right? Their interest is getting yield on their private cryptocurrency holdings, and B, growing the circular economy so that they have more places to spend their private cryptocurrency. And, in the future, there's more of an economy which exists for this stuff, more liquidity, more options for transacting within the ecosystem. So they're probably going to prioritize getting paid in Zano, Freedom Dollar, Monero. And then Mike, in his business planner prospectus, establishes that the dividend policy will be a 20% constant payout ratio. And that basically means that it'll be a fixed percentage of the quarterly earnings. And we'll get to the accounting part later. But, this could be done on a quarterly basis, semi-annually basis, annual basis. It's up to the company to kind of determine that. So Mike issues 20,000 of the 100,000 tokens that he had minted on Zano Trade at a par value of $1 per token. Now, Mike is careful not to issue too many tokens. Um, and this is a little bit counterintuitive because typically when it comes to some of these tokens out there, if the tokens are too centralized amongst too few wallets, then that's a red flag for people. It's not, broadly distributed, and so there's a risk of, something, right? Like a rug pull or something or the other. Now, it's a little bit different in this context because if the company issues too many of the tokens, then they're going to be less incentivized actually to pay out the dividends and to increase the value of their token holdings. And there are two different assets in this ecosystem that the company is trying to raise the value of. Number one is the token, and by consistent, successful dividend payments over time to token holders, the value of the token increases. And the reason for that is because not only, you know, is it evidencing that there's a yield to be had by holding the tokens, but it's also that the trust is going up in the company. And in a private peer-to-peer marketplace, trust is a huge factor. Reputation is a huge factor. And if you can build up trust in association with, let's say, your alias in the Zano peer-to-peer private capital market ecosystem, then you're going to be able to effectively raise capital for cheaper. So we'll get to this in an objection down the line in regards to people saying, well, what if somebody rug pulls or what if somebody does this or that? Well, if somebody blows up that hard earned trust that in some cases can take years to build, then that's going to be them shooting themselves in the foot because it's by having trust in this peer-to-peer private capital marketplace that allows you to get cheap financing that's completely off grid. And so trust is probably, and ironically, the biggest asset that somebody can develop in this ecosystem because it's going to allow you to get cheaper financing, it's going to allow you to get more financing, and it's going to have people support your project um, in a way that they're not going to support other projects. So you're going to have a big competitive advantage the more trust that you can garner with the people in this ecosystem. So, issuing too many tokens indicates a lack of incentive as the value of the tokens would increase due to, like we said before, consistent and successful dividend payments to token holders and then increases in cash flows seen in the Zano auditable wallet and Monero wallets. And we'll get to that here in a sec. So Mike successfully raises $20,000 in Zano from the offering. The Zano balance is seen publicly in the auditable wallet. Mike can convert the Zano to Freedom Dollar or Monero, all of which can be seen via the auditable wallet or Monero view keys. Mike sets up books so as to account for his business transactions and publishes monthly financial reports to the public. Mike purchases his lemonade stand and raw materials needed to begin conducting business. So all that's pretty straightforward. And again, because the wallet is an auditable wallet, we're going to be able to see him spending the Zano on whatever he needs to get for the lemonade stand. Now, depending on how in depth he wants to go with being transparent with the investors, he can upload receipts of his purchases for the materials for the lemonade stand. He can take a picture of the lemonade stand once it's set up for the social media accounts. He can post, receipts he receives from the local store, ideally with the local store's name and address kind of blocked out, with the materials like the lemons, like the sugar, whatever, notated on the receipt so as to evidence the purchase. Because it could be that he's got to cash out the Zano in order to get into a more liquid currency. In order to do that, we'll get to that here in a little bit as well. So paying dividends. So Mike begins business operations on January 1st, 2026. A quarter passes. He releases financial reports for the first quarter. And then on June 10th, let's say he broke even the first quarter. On June 10th, he finally has a profit. And he releases his second quarter financial reports. And as with most companies, they typically announce a dividend once they issue the reports. So he has $10,000 in profits. Per the policy, Mike announces the issuance of a $2,000 dividend to token holders. So Mike requests investors, and this is where it gets a little bit interesting. Mike requests investors to open escrow contracts with his wallet, MHLS, to prove their token holdings because it's a private blockchain. It's not like he can look at which addresses hold which tokens and then just send out the funds to those addresses. He has to basically garner the investors to open an escrow contract And we'll get to that in the next slide in regards to what that looks like. But through the escrow contract, they prove the reserves of the token. And so during the dividend declaration period, which is a week, the investors are going to open these contracts. And on June 17th, 1 week later, the dividends are going to be paid to those who open the contracts. So the investor posts the token holdings as collateral to prove reserves. The investor sets a contract expiry time to 1 week. The investor leaves a comment on the contract specifying the preferred denomination for the dividend and alternate address for payments if requested. So let's say that he wants to receive his dividend in the form of Monero. He can post his Monero address in the comments section. Otherwise, the address which is opening the escrow contract with the MHLS wallet is going to be the address to where the company needs to send the dividend. That'll kind of be the default place to send it. So the seller should not accept the contract, and this is pretty important. Now they can back out of the contract if they want to do that, and we'll get to the contract in the next slide, but generally the contract is just meant to prove reserves. It's not meant to be accepted, but in case this happens, the investor needs to, when they create the contract, request significant collateral from the seller to accept the contract so as to hedge and disincentivize a potentiality where you open up a contract and then you kind of get into this weird situation where like either the contract has to go through or you have to cancel the contract. And when you cancel one of these contracts, because both the parties can't agree, the collateral is burned, which of course disincentivizes them to canceling the contract and then having the contract be accepted. And again, we'll get to that here in a sec. And then the seller should not pay any dividends prior to the dividend date. And the reason for that is the investor could receive the dividend, move the tokens to a different wallet, and then request another dividend with the same tokens and act as if they're another investor, right? So that's why there's this week for everyone to open up these contracts. And then on this day, that's when you pay out all these contracts and nobody can open contracts after that point. So this is what a Zano escrow contract looks like. And this is what it looks like inside the wallet. If you've never seen inside the, frame of a Zano wallet, you've got your alias up here. So up here would be, you know, um, well, this would be on the side of the investor, but that's where the alias is. Um, Description. So in the description, you would say uh, for the receipt of the dividend, right? For MHLS Q2 dividend. The seller would be MHLS, and presumably you can just put that alias in there, and then it'll populate the address. Now, for the amount, what you can do is you can just put like a super small amount. You could put like 1 Zano or something, so that if the contract is accepted, then instead of like canceling the contract and having your collateral burned, you just have, a little Zano payment go through just, so that you could get your collateral back and so that you can kind of just move on. But your deposit, the seller deposit, this is your collateral. So this is where you're going to put your, um, your token holdings for MHLS. This will prove your reserves. And then the seller deposit, you can make like a really ridiculous amount. You can make it um, like 1 million Zano or something like that, just in case they happen to do something tricky or funny. They definitely pay a consequence for doing that. And in the comment down here, in the comment box, you could say requesting dividend in the form of Monero, and then you could put your Monero address. Here's your fee and your time till response down here. This is where you would put the expiry time. So you could put 12 hours, 24 hours, you could put a week. And in this case, you would put a week, assuming that you open up the contract, at the time that the dividend was declared. So, All right, business expansion. So, as a result of the successful dividend payment, confidence in MHLS grows and the token value appreciates. So, because trust is being built and because there's a proven yield to holding these tokens, the token value is going to appreciate and the market's going to like that. It's going to attract more capital. And as a result of the increased token value, Mike wants to sell some tokens to raise more funds to expand the business operations. Mike discloses on his social media that he intends to sell another 5,000 tokens to raise more capital to open a second lemonade stand. And the reason he wants to do this is because, again, he has an auditable wallet. And everybody is kind of looking very closely at his balance of tokens because if that starts to move without any justification, it may indicate that either a rug pull is about to happen or something that the market doesn't understand is happening. And so he's going to want to be pretty transparent if he's going to start to sell more tokens because, again, trust is the biggest asset that these companies have. The more transparency that you have, the more trust you have, and the more that you can justify continued investment in the company. So, just as a corporation would, they're going to announce to the public that, hey, we're going to sell more shares into the market. And so he sells the 5,000 tokens on Zano trade for the appreciated market value so that he can build his second lemonade stand. So um, operations continue as Mike's operations expand. It could be necessary he needs to exchange Monero to Zano to more liquid currencies, or Monero or Zano to more liquid currencies. Ideally, these are cryptocurrencies for which the addresses would be made public. So, like, let's say that he needs to get into Bitcoin or Litecoin or something like that that's more liquid, that more people accept in his local area. And if he goes to those cryptos, presumably he would post the addresses for those publicly so people can see the cash flows relating to that activity. The only problem with that is, again, if blockchain tracing gets involved and he's using the internet to check on transactions that he's doing, and he links his IP address maybe with those wallets, then that causes problems in regards to anonymity. One little note in regards to Zano. Zano's still, I think, working on the network anonymity problem. You all may remember from a few months ago that people were staking their coins, and there was somebody who was able to trace via spy nodes who was receiving those coins. At least they could see the coins going to certain wallets that were associated with certain IP addresses. And so Zano is working on improving their network anonymity. Monero has Dandelion plus plus, which means you have a kind of mixer in place for Monero that mixes your IP address with other IP addresses. So there's some level of obfuscation there in regards to using Monero. But most other cryptocurrencies, they don't use some kind of IP obfuscation technique. And so you have more metadata leaking. And so Zano's working on that, but preferably you're staying in these two coins. One, because those are fewer wallets that people have to view and people have to check up on to see how the operations are coming. And two, that protects the anonymity of the company. So he could sell also for fiat currencies, but this increases risk for investors since they cannot see the transaction activity occurring off chain. Mike could publish receipts relating to these off chain purchases online, but something I've seen recently is that people are AI generating receipts, which is really funny because what some businesses are doing now is they're taking cash out of their bank and they're doing whatever with it. They could be expensing it for personal reasons, but what they do is they generate these AI receipts so that they can make their cash purchases for their personal life look like their business expenses. And that is something that is increasingly happening, and maybe that could happen in this case too. But you're going to want to look closely at these receipts. And again, the more that he is able to evidence that he is having legitimate transactions take place, whether that's photographic or video or whatever. And AI is going to make all of this a little bit more difficult moving forward. Uh, the more evidence there is, the more transparency, the better. But this is why it's, again, best if he uses Monero or Zano through a view key wallet or auditable wallet, because these transactions are occurring on chain and you can see these transactions take place. And there's a better accounting. There's a better accounting of that happening. So um, next, investors would need to rely on the integrity of the books and conduct ratio analysis to analyze the reasonableness of the activity. And we'll get to that later in regards to an objective that people could have to this whole thing. So let's talk about accounting. Um, so Mike needs to make sure he's properly accounting for his business activity to maintain investor confidence. Again, the more information, the more transparency, the more trust, the higher valuation the company is going to have on the market. Mike needs to reconcile the transactions that the investors can see on chain via the view key and auditable wallets with the books. So if he's got a set of books and he's got these inflows and outflows with these transactions on these wallets from Monero and Zano, he needs to record those transactions and then he needs to reconcile the value of his Monero and Zano wallets with the books. Now, the books, they record assets like cryptocurrencies at a historical cost basis. But what he could do is he could publish, Coinly gain or loss transaction reports as well with the financial statements every month, so people can reconcile the transactions taking place in the respective wallets with the totals that amount to the books, to the gain or loss calculations and the cost basis determination that is done on a third party gain or loss software like Coinly. And so all these records would be uploaded to the social media site, the Dread, the Reddit, whatever this person decides to use, so as to evidence and provide transparency to the activity that's taking place within the Monero or the Zano wallets. Because in regards to auditable wallets, you don't actually know what the transactions are for when they're occurring, but you can just see that the transactions are happening. And so the better the accounting, the more trust, again, the investors are going to have. And the investors can do their own reconciliations with the information that is public. The investors can do their own ratio analysis on the profit and loss and balance sheet statements so as to determine whether or not there are things that just don't add up. And they can then do industry analysis so that if they know that you're a lemonade stand company, they can compare your financials with other lemonade stand companies that may have public information, and they can determine the reasonableness of your statements. They can see whether or not you're operating it efficiently, whether there are things that just seem to be missing. And if there are things that seem to be missing, or it just doesn't look like you're running a good company, then that's going to lower the value of their company. And this we'll get to in regards to another objection about, well, what if he's receiving payments from customers, but they're off chain? They're not going into the Monero Zano wallets. Well, that's going to reduce the value of his business and the value of his tokens accordingly. Because if he's receiving off grid money, kind of in the same way that a business accepts cash so that they can hide it from the tax man, well, if you're hiding cash from the investor, then that's going to lower the value of your business, right? And that's going to cause people to ask questions, and that could lower the value of your tokens. And because you're holding most of the tokens, you have an incentive not to do that. And again, this is why investors are going to be looking closely as to why you may not have as many tokens as they would like. So if you have like a 50% holding ratio of the tokens, then they could be a little bit concerned by that 50% or less, because they may think that, oh, he doesn't really have too much of a stake in the game. He's going to be less incentivized to present honest information. So um, it is a little bit topsy turvy because, again, it's like in most crypto projects, it's a little bit worrisome if somebody holds a lot of the coins. But in this kind of case, it's a little bit different because you want the person to be incentivized for increasing the value of their tokens. Okay, so Mike can use Edge Wallet to classify the transactions, at least for Monero. So if you're using an auditable wallet with Zano, I don't think that you can do that through Edge Wallet. I haven't checked. I don't think you can do that. I think you have to use the Zano desktop wallet. They don't have transaction classification features, but you can still export the transactions to a CSV file. Excuse me. But um, yeah, so you can still upload those transactions, and then you can add information to those transactions on the CSV file after the fact, and then you can upload that, with your financial statements every month or every quarter. Mike can work with an external bookkeeper anonymously and have them log transactions into the books as they occur on chain. Mike can send a report intermittently to the bookkeeper to input transaction classifications correctly. This is just in case Mike doesn't know how to use QuickBooks or some kind of accounting software. He just uses a third party in order to log those transactions and put it into the context of a proper financial statement. Mike can then use a third party software like Coinly to input the CSV files monthly, quarterly, etc., so as to figure the gain loss for the period. And this assumes that the books aren't denominated in Monero or Zano. If they are, then maybe you don't have to record a gain or loss at all. All right, let's get to objections and rebuttals. So the first one is basically like, what if it's a Ponzi scheme, right? The company secretly assumes off balance sheet liabilities and inflates the on chain cash flows. So let's say that he gets a loan, right, from an outside source, and his business isn't doing well. So he wants to get a loan so as to buy Monero or Zano and then deposit those amounts into the wallets as sales so the investors can see the incoming cash flow. And if the investors see that on chain activity, but they don't know about the loan, then they're going to think that the company is making sales. And from those sales, dividends are going to be paid, and that's going to increase the value of the token. But the balance sheet doesn't record there being a liability. So this gives investors a false sense of optimism about the company's successes. It's unsustainable for the company and may lead to a sudden liquidation of the tokens to pay the liability. And if the company's going great, you wouldn't think the company would be incentivized to do that kind of liquidation, again, because they're building up trust. But if they have some kind of call from the lender saying, hey, you got to pay back this loan, and this person doesn't have another way of getting the money, then he's just going to liquidate the tokens. And that's a pretty significant risk. And so what we're effectively talking about is a Ponzi scheme that leads to either the default on the lender, a rug pull for the investors, or maybe both, right? So that's a risk, off balance sheet liabilities. Now here's the rebuttal. Investors should look out for inflated sales relative to expenses. So if you're looking at the P&L that they're releasing every quarter, it's like, okay, that's a lot of sales relative to the expenses that you're paying. Either the business is going very, very well, or there's something fishy here and he's taking outside capital from somewhere. And so you have to do some ratio analysis. Do the ratios make sense for a company in this industry? Are the margins correct? Your gross profit, does that make sense? Revenues minus cost of goods sold. What kind of overhead are we looking at, etc. The company can upload sales receipts so that when he sells, to a customer and he prints a receipt for the customer, he can upload that to the portal or wherever it is that he's uploading all this financial information for the investors. But of course, these could be self sales. He could just be buying the lemonade from himself. The investors should look for unjustified token sales from the issuer's auditable wallet. So if the issuer starts to sell tokens without alerting the investors um, with a reason as to why he needs to sell the tokens to raise capital, that could be a red flag. And the owner could also make up false reasons for the token sale. So let's say that he wants to open up a third lemonade stand, but he doesn't intend to open up a third lemonade stand. Then that could essentially be him making up a false reason as to why he wants to sell these tokens, and he's really just trying to pay this off balance sheet liability, right? That's a risk. So, this is where more transparency is good. If they have a social media account, then they can show themselves having the plans, the blueprints, whatever, for building this other lemonade stand. But, again, it's hard to kind of do some of this stuff when you don't have third party assurance. And maybe there are, these companies which pop up in this marketplace to grant some third party assurance, and those third parties, they build up their own asset within the ecosystem as being somebody with good reputation, and then they're called out by these people so as to do an analysis on what's actually going on the ground with the business, do audits of the financial statements, so on and so forth. The only problem is, what if these people are bad people, right, in one way or another, and that could lead to some complications. So the other objection rebuttal, the owner sells or leaves the company without announcement. So we're talking about a rug pull. If they sell the company, it's unreasonable to expect them to issue sales proceeds slash profits to the dividend holders, or not the dividend holders, the token holders. That's a typo. Since the business would effectively end thereafter and they don't have an incentive to make that payment, right? So you should actually look at these tokens that people are purchasing not as, piece of ownership of the company, but more or less as profit interests, right? Where you're receiving a certain percentage of the profits from the business operations. But if the guy goes to sell the company to somebody, it would be unreasonable to expect that whoever he's selling the company to is just going to continue the operations. Now, if this person maybe wants to sell the company and then use those proceeds to then build another company, but wants to maintain that trust within the ecosystem, what they could do is they could effectively distribute the proceeds of that sale, or at least try to issue enough funds to the dividend holders, so as to make them whole, and to appease the market. But you shouldn't rely on them doing that. That could be, kind of a high level proposition. But what they could do is they could do that, and then they could start a new company under their old alias within the marketplace, and then they could, have a lot of good credit within the ecosystem and receive more funding. Because again, trust is something that's a pretty high value thing. So here are the rebuttals to this critique here. You're going to want to look at the numbers in social media activity for unexpected slash unexplained changes in activity. There will typically be signs before a kind of rug pull happens, and you're going to want to respond accordingly as an investor. Now, if they die or experience a tragic end, there is virtually no recourse. You're just kind of cooked, right? Because we're talking about a peer to peer system. There's not going to be some kind of like estate or third party which is going to pay out to you and make you whole. Like all this stuff is presumably taking place in the middle of a jungle, off system, in a kind of lawless type of environment. So it's like, if the guy dies or disappears, you're just kind of cooked. Now, are they going to disappear if they have a lot of valuable tokens in their wallet? That's less likely, but if they die, I mean, they don't care. They're dead. Doesn't matter. Excuse me. All right, so the owner would be disincentivized to do this, i.e., just leave if they hold valuable or appreciated tokens and have established a good reputation that forms the basis for that value. In this marketplace, trust trades at a high premium. It's difficult to build and easy to destroy. The owner would be self-interested to maintain that trust, to maintain that value for future endeavors in the space should they decide to do something else, which is kind of what we talked about before. Okay, objection number 3. The owner will accept off-chain payments from customers to hide revenue and reduce profits, and therefore the dividend payments. And the rebuttal to this is kind of what we talked about before. Many businesses do this except in a desire to evade taxes. But the consequence is that their business looks less profitable to investors slash lenders and the value of their business is therefore lower. And this is what accountants run into all the time, where it's like a business needs to get a loan so that they can expand their business operations, but they also want to take a lot of deductions so that they can lower their tax bill. And you kind of have to pick what you want to do, because if you want to lower your tax bill, you're obviously going to make your income look as little as possible. Just as in this context, if you want to limit the amount of dividends that you're paying to your investors, you're going to make your income look as little as possible. The only problem is lenders and investors are going to be less inclined to give you money if you have lower profits. So you got to kind of pick what direction you want to take. And if they have a long term perspective, they're going to want to have good profits for their business so as to incentivize more investors, to incentivize a higher token value, and to, have a longer term sustainable business track. So doing this reduce interest from investors in the company as they believe the company isn't being managed well or isn't profitable, the token value would decline. Okay. And this is the last objection that I could think of, and I'm sure you all have a number of other objections for sure. But how would a company issue dividends manually? Because you do have to kind of do this manually. There's no batch transaction thing you can do. How would you issue dividends manually to so many people opening contracts with them? Per the example, there's a potential for 20,000 contracts to be open because you have 20,000 coins out there. And so the rebuttal to this is the company would need to establish probably a minimum holding requirement for the token ownership regarding the dividend payments. So somebody would need to have at least, let's say, 200 tokens or something like that, $200 invested in the company if they want to receive any kind of dividend at all. Because there's a cost to opening up the contract, there's a cost for the transaction to be done for the dividend payment. So it has to be at least some kind of de minimis amount that you hold. Now, people can still own fractional shares of these coins, right? And they can own, uh, smaller than the minimum, but they would only benefit from the price appreciation. It would effectively be a speculative, non-yielding asset. And Zano doesn't have a feature to make batch transactions to token holders, as is the case with Ravencoin, which I heard you can do. So Ravencoin, you can do these kinds of assets. You can mint assets, people trade these assets, and the issuing wallet can effectively pay out amounts to all the people who hold these assets pro rata with one batch transaction, which is a pretty cool feature. But the only problem with that is if there are wallets that hold these tokens that people no longer have access to, then when these batch transactions are made, then you're just going to be having coins go down the drain. They're going to go into a black hole, never to see the light of day again. And so it's actually best if the investors open up these contracts because that proves not only the reserves, but it proves that they have access to the reserves. So last slide, impacts. What would happen if this idea really took off? Well, more businesses would be encouraged to adopt private cryptos as a method for obtaining financing. Businesses would be incentivized to encourage their customers and vendors to adopt private cryptos like Zano and Monero. Businesses are encouraged to swap cash for Monero and Zano so as to earn yield and protect against inflation, because with cash under your mattress, you're not earning a yield. And you're also not protecting yourself against inflation. And so if you swap that into Monero and Zano, which are cryptos which do have tail emissions, like Zano does have, I think, a 3% per year tail emission. Monero, you have zero point 0.6, I believe, blocks, or excuse me, zero point 0.6 Monero being produced every 2 minutes, I believe, in tail emission into perpetuity. But the inflation rate, I think, is something like 0.6% per year. I would need to go back and check, but it's very low. It's like lower than gold. Zano, I think, is 3% per year. So the inflation of fiat currencies is more than these coins. And if you're holding cash and it's not in like a high yield savings account, then you're just kind of at a disadvantage relative to Monero and Zano if you're able to get some kind of yield by investing in peer-to-peer private capital markets. Investors can earn yield on their private cryptocurrencies, and there are more outlets for spending and earning private cryptocurrencies. Now, I do want to go back to um, this slide here. to my disclaimer, I mean, all this could very well be illegal wherever you are, right? So I'm not trying to encourage people to do this. We're just kind of exploring, how this would work in a hypothetical sense. As far as I know, there are um, big pushes right now for the tokenization of assets. So Larry Fink, for example, at BlackRock, he's coming up with his own technology so as to tokenize stocks, bonds, real estate, and all these different things. And tokenization is going to be a feature of the future. But in many cases, these tokens are going to be considered securities. The only problem is, along with that, is the fact that the tokens are going to be able to be seen by everybody. And so I think in the future there is going to be a place for private tokens, but in this kind of context, it very well may be hard to do this legally. So I just want to point that out. I'm not endorsing anybody go do this, but um, these are pretty interesting ideas. I think they're just interesting. So if you ever move to the jungle and there's no law there and whatever, and you want to set up a lemonade stand, I guess this would be how you do it. So um, that's all I got for you, man. Mateo. Leave comments. I'm interested what you guys think about this. And yeah, like, comment, subscribe. God bless you in the next one.